Assalamualaikum to Madam and all my friends. We will present for chapter 2 topic, which is overview of the financial system. My name is Nur Alifa and I will present for subtopic in chapter 2, which is direct finance and indirect finance, structure of financial market and financial market instrument. The financial system is considered as the backbone of an economy, and this is shown as in the diagram. Next, we move to function of financial market. Financial market perform the function of channeling fund from people who have surplus fund to people who have a shortage of fund. Those who have saved are the lender savers or surplus unit, and those who must borrow are the borrower spender or deficit unit. The surplus unit are households, but business, enterprise and the government, as well as foreigners, also find themselves with excess fund and lend them out. Deficit unit are businesses and government, but household and foreigners also borrow to finance their purchases. Next, we go to flow of saving and investment into sector economy. Financial intermediation is a process where governments, commercial banks, savings and loan associations, mutual savings banks, credit unions, insurance companies, pension funds and mutual funds transfer funds from savers to investors. Financial disintermediation is a process where savers take funds out of deposit accounts and invest directly in bonds, stock and others. Now we look to direct finance and indirect finance. Direct finance funds are obtained by borrowers directly from lender in financial market by selling them lender securities or financial instruments which are claimed on the borrower's further income or asset. An example of a direct finance is the issuance of common stock or bond. These securities are first issued in primary markets and then resold in the secondary markets. Indirect finance. This occurs as a result of financial intermediation, which is a process where governments, commercial banks, savings and loan institutions, mutual saving banks, credit unions, insurance companies, pension funds and mutual funds transfer funds from savers to investors. Indirect finance are more important source of financing for corporations than direct finance in many countries. Next, we look to structure of financial markets. First is debt and equity markets. The most common method is the issuance of a debt instrument such as a bond or a mortgage. A debt instrument is short-term if its maturity is less than a year, long-term if its maturity is 10 years or longer, and intermediate terms if its maturity between 1 to 10 years. Other method of raising fund is by issuing equities, such as common stock, which are claimed to share in the net income and the assets of the business. Second is primary and secondary markets. A primary market is a financial market in which new issue of a security, such as a bond or a stock, are sold to initial buyers by the corporation or government agency borrowing the fund. A second market is a financial market in which securities that have been previously issued second-hand can be resold. Security brokers and dealers are crucial to a well-functioning secondary market. Brokers are agents of investors who match buyer with seller of securities. Dealers link buyers and sellers by buying and selling securities at stated price. Third is exchange and over-the-counter. Exchange is where buyers and sellers of securities or their agents or brokers meet in one central location to conduct trade. For example is KLSE, which is Kuala Lumpur Stock Exchange. For over-the-counter, OTC, which dealers at different locations who have a inventory of securities stand ready to buy and sell security. Because OTC dealers are in computer contact and know the price set by one another, the market is very competitive and not very different from a market with an organized exchange. The last one is money and capital market. Money market is a financial market in which only short-term debt instruments are traded. This market usually more widely to be more liquid. In addition, short-term securities have smaller fluctuation in price than long-term securities. The capital market involves longer-term securities, usually more than 1 year, and equity instruments. Capital market securities are often held by financial intermediaries, such as insurance companies and pension funds, which have little uncertainty about the amount of funds they will have available in the future. Next is financial market instruments. Financial instruments are traded by both individual households and firms and by financial institutions in a wide variety of financial markets. The markets are categorized into two broad markets. First is primary markets and second is secondary markets. The issuance of stock and bonds for the first time usually take place in the primary security markets. When securities are bought or sold after the initial offering, they are being negotiated in the secondary markets. For example, in Malaysia are KLSC and KLOFFE. Both financial markets, primary and secondary, can be further classified according to certain characteristics. Capital market transactions include trading of security with a maturity of 1 year or more. It's a long-term security. Examples are the stock markets, mortgage markets, corporate bond markets, and the government security markets. The money markets consist of securities issued in principle for 1 year or less. It is short-term security. This market typically apply to the trading or credit instrument issued for less than 1 year.
Assalamualaikum to Doctor and my fellow friends. I'm Wan Shahira. I will continue the present of this chapter. The next topic is 2.1.4, the clarification of financial market instrument. The money market instruments are divided into two types. They are non-government papers and government papers. In non-government papers, there are four instruments involved. They are bank acceptance, repurchase agreement, negotiable instrument of deposits, and commercial papers. For non-government papers, for BA, this instrument is negotiable instrument or time drawn on and it is accepted by a bank. These BAs are to carry out international trade and have been in use for hundreds of years. A bank draft, the promise of payment similar to a check. It is issued by firm, payable at some future time. It is guaranteed for a fee by bank with a stamp it accepted. It is required to deposit the required fund into an account to cover the draft. If the firm fails to do so, the bank guarantee means that if the obligation to make good on the draft. The advantage to the firm when using this instrument, the draft is more likely to be accepted when purchasing goods abroad because the foreign exporter know that even if the company purchasing the good goes bankrupt, the bank draft will still pay off. These accepted drafts are often resold in a secondary market at a discount and so familiar with function to the treasury bills. Second instrument of these non-government papers is repurchase agreements, repos. These instruments are made by usually a bank to sell securities to its customer, coupled with an agreement to purchase them at the price that already accumulate with interest. They are effectively short-term loans, usually with maturity of less than 2 weeks. It with treasury bills serve as a collateral and asset that a lender receives if the borrower does not pay back the loan. The third instrument is Negotiable Instrument of Deposit, NIDS or NCDS. Is the debt instrument sold by a bank to depositor that pay annual interest of given amount and at maturity pays back the original purchase price. Originally, NIDS were non-negotiable, that is, they could not be sold to someone else and could not be redeemed from the bank before maturity without paying a sustainable penalty. But today, they are negotiable and now issued by almost all major commercial banks and has been extremely successful. The advantage of an IDS is negotiable compared to fixed deposit, and holder has opportunity to make profit, and if it minimize loss in anticipation of interest movement. And the last and the last instrument of the non-government papers is commercial papers. Commercial papers is a short-term debt instrument issued by large bank and well-known corporation. Before this, corporation usually borrow their short-term fund from bank, but they have come to rely more heavily on selling CP to other financial intermediaries and corporations for their intermediate borrowing needs, or they engage in the direct finance. Short-term debt obligation, usually with maturity less than 9 months, issued by companies that need to raise funds for use a relative short period of time. For government papers, the instruments involved are three. First, Malaysia Government Securities (MGS). Second, Malaysia Government Treasury Bills (MGTB). And the last one is Jagamas Bond and Notes. For Malaysia Government Securities, it is concerned of government bonds and loan stock, which represent our government borrowings from the private sector. It is issued on a tender basis from the Treasury via BNM. It can be traded in the secondary market and the price is determined by the force of demand and supply. It is indicative price of MGS is reflected by BNM's monthly published price listing. The dividend is payable to the holder half-yearly at specific date. Upon maturity, principal amount will be paid. The role of the MGS is to help meet the government expenditure, to provide needs of government agencies like APF, BSN, whom are required by law to hold certain portion of their asset in MGS, to meet short-term investment outlet of the financial institution and other corporation, for example, insurance company, and the last one is provide liquid asset requirement of commercial banks, merchant bank, and financial company. For Malaysia Government Treasury Bill, in general, Treasury Bill (TB) are short-term debt instrument of the Malaysian government. They pay a set amount at maturity and have no interest payment, but they effectively pay interest by initial selling at a discount that is at the price lower than the set amount paid at maturity. In general also, T-bills are most liquid of the money market instrument because they are most actively traded. They are also the safest all the money market instrument because there is almost no possibility of default. MGTB are short-term government securities with maturities not exceeding 1 year, payable to order and entitle the holder the payment of the fixed deposit sum. For example, face value at the fixed maturity date. The issuing of MGTB come about as a result of legal minimum liquid asset required imposed by BNM in 1959 on commercial banks. Since in inception, the issue and redemption of MGTB are managed by BNM on behalf of the government. There are three series of MGTB. For example, 91 days, 182 days, and 365 days. 91 days MGTB are issued weekly, while 182 days and 364 days are issued fortnightly and monthly respectively. The role of MGTB is it provides investment outlet for short-term surplus fund of commercial banks, merchant bank, and discount houses and finance company. It serves as liquid asset of commercial bank, merchant bank, and finance company, and hence the liquidity of the banking system. It helps the government to finance its working capital at the very low cost. MGTBs are issued at the discount and payable at face value upon maturity. They are issued and payable to order in minimum denomination of 100,000 ringgit. For Cagamas Bond and Notes, Cagamas Berhad, the National Mortgage Corporation, was established in 1986 to promote the secondary mortgage market in Malaysia. Its corporate mission is to provide financial products and services that would improve the availability and affordability of loans for the purchase of home, particularly for the lower income group. It borrows money by issuing debt security and use the fund to finance the purchase of housing loan from the financial institution, selected corporation and the government. Jagamas issue four types of debt security to fund its mortgage purchase activities, namely fixed rate bonds, floating rate bonds, short-term discount notes, known as Jagamas notes, and Jagamas Mudharabah bond, which are interest-free bonds issued under the Islamic principle of profit sharing. Jagamas fund is purchase of loan primarily through the issuance of Jagamas debt securities. The fourth type of debt security issued by Jagamas to fund its portfolio of loan purchase under the facilities for housing loan, industry property loans, hire purchase and leasing debt, and the Islamic housing financial financing debt. They are Jagamas fixed rate bonds. The Jagamas fixed rate bonds are the bond have tenure of 1.5 to 7 years and carry a fixed coupon rate, which is determined at the point of issuance based on the tender submitted by the principal dealer. Interest on this bond is paid half yearly. The redemption of the bond is nominal value together with the interest due on maturity date. Second one is Jagamas floating rate bonds. These instruments are tenure of up to 7 years and adjustable interest rate, paid to the 3-month or 6-month CLIBOR. The interest rate is reset every 3 or 6 months, while interest is paid at 3 or 6 month intervals. They are redeemed at face value together with the interest due upon maturity. Third one is Jagamas note. These are short-term instruments with maturity between 1 to 12 months issued at discount from the face value. The other features of this note are similar to those Malaysian treasury bills. They are redeemable at their nominal value upon maturity. The last one is Sanadat Mudharabah Jagamas. These are Islamic bond issued under the Islamic principle of Mudharabah, which is profit sharing, to finance the purchase of Islamic housing financing debt, which will grant on the base of al-bay' bitaman ajil. Dividend based on the predetermined profit sharing ratio is payable semi-annually. This instrument may have tenure of up to 7 years. The capital market instruments are divided into two types. They are equity instrument and debt instrument. For equity instrument, they have two stocks involved. First, common stock. Second is preferred stock. For the common stock, share of ownership in the firm that carry the right votes. Last claim upon asset and dividends of the company, hence bearing the greatest risk of loss. For the preferred stock, it is do not entitle shareholders of voting rights. It is the first claim against asset and dividend compared to the common stock. For the debt instrument, they have four items. First, mortgage. Second, corporate bonds. Third, convertible bonds. And the last one is junk bond. For the mortgage, these are loans to the household or firms to purchase the housing, land, or other real structure where the structure or land itself serves as collateral for the loans. For the corporate bond, these are intermediate to long-term debt obligation issued by the companies. It may be issued directly or through broker. For the convertible bond, these are the debt instruments that are convertible into stock at the specific price at the discretion of the holder. And the last one is the junk bonds. It is the corporate bonds that post both high yield and high yield. Okay.
Assalamualaikum warahmatullahi wabarakatuh to Madam and my fellow friends. I'm Noliana. I will continue the sharing for the last 3 points in this chapter. For 2.1.5 is about financial institutions and intermediaries. For 2.1.6 about major structure of financial intermediaries. And the last 2.1.7 banking and non-banking institutions. 2.1.5 Financial intermediaries refer to the institutions that channel funds from lender to borrower to meet the financial objective of the both party. On the diagram and example, we can see the business entity which accept the deposit from the lender by allowing them low interest on their sum. For the organization, they lend their amount to the borrower at the comparatively high rate on interest to make the margin. We have a lot of financial institutions. Financial institutions are part of the financial intermediaries. For example, bank, insurance companies, mutual fund company, and others can refer to diagram 2.0 in the textbook. Actually, the process of indirect finance using financial intermediaries is called financial intermediation. Four major functions of financial institution. First is saving function, provide potentially profitable and relatively low risk outlet for public saving. Second, liquidity function, provide a means of raising funds by converting security and other financial assets to cash balance. Third is policy function, provide a channel for government policy, achieve the nation goal of high employment, low inflation, sustainable economic growth, and favorable international payment position. Last is wealth function, provide a means to store purchasing power until needed a future date for spending on goods and services. 2.1.6 Major structure of financial intermediaries. First is depository institution. This institution generally take their customer deposit as a saving or investment and lend them to the borrower. The most commonly viewed intermediary, the commercial bank, raise the loan amount through the saving or by issuing checkable deposit and time deposit. On the other hand, credit unions are all about deposit in the form of share. Typically, the shareholders are the members or employees of an organization. This institution is important because they involve in deposit creation and important component money supply. Second is contractual saving institution. These most familiar contractual saving institutions are life insurance company, pension fund, or retirement fund provided by the government. This type of intermediaries get their hand on funds at periodic intervals. Working entirely based on a contract, this institution work under a specific list of conditions. The insurance company get the fund through premium paid by policyholder. Pension fund work with retirement benefit in an annuity. The liquidity asset is not as important consideration for them as its depository, and they tend to invest their fund primarily in long-term security. Last is investment intermediaries. The hedge fund, which is only accessible to accredited investor, is also included in this category. This entity issue and sell their company share and later invest the proceeds in a different diversified portfolio of security. The fund include corporate bond fund, stock mutual fund, money market mutual fund, and mortgage-backed security fund. Although the commercial bank always has the edge for being the large indirect investment source, hedge fund and insurance company are not far behind. These three altogether are being the large source of financial help to the business across the globe. Small and medium-sized business are becoming a major source of the economy with this indirect finance method. 2.1.7 Banking and non-banking institution. The main difference between both is that non-banking financial institutions cannot accept deposit into saving and demand deposit account, while it is one of the core business for banking financial institutions. Here I may summarize for all the 13-point variety of the service from the textbook into these 4 points. First is insurance companies. Insurance companies offer a protection against specific loss in exchange for an insurance premium. Second is investment bank. Investment bank offer service to their clients such as underwriting of debt and share issue, corporate advisor, security trading, and derivatives transaction, and other investment service. Third is provident, pension, and mutual funds. Provident and pension and mutual fund are saving institutions where investors are able to invest their fund in collective investment vehicle. Last is saving institution. Saving institutions are mobilized a significant amount of small savings, especially from lower fixed income group and those in the rural area. That's all from us, and thank you for listening.